Hi, welcome to Market Week in Review for the week ending June 27th, 2025. I'm Paul Edelman, Global Chief Investment Strategist for Russell Investments. And I'd say in short, this week has been a phenomenal week for global financial markets. We're tracking returns on both US and global equities of around 3% on the week to Thursday's close, which is a really outstanding result. And that positivity extends beyond the equity market, where even in fixed income, sovereign rates have been declining, with the US 10-year Treasury yield, for example, down 13 basis points, again, on the week to Thursday's close. So strength both across the equity and fixed income complex. Under the hood of that, in terms of fundamental drivers of the move, it's been actually a pretty quiet week, but a couple of things stand out to us. From a monetary policy perspective, at the start of this week, we had chatter from two Fed governors, Mickey Bowman and Chris Waller, suggesting they could be open to another Fed rate cut as early as their next meeting in July, which I think caught the financial markets by surprise. Later in the week, though, Chair Powell was a little bit more measured than that in his semi-annual monetary policy report to Congress. It seemed like Powell wanted to see two more good inflation reports for the months of June and July before he'd be willing to cut interest rates in a world of resilient economic activity. That would set the stage a little bit more likely for the next Fed move being in September instead of July. And September's our baseline expectation for the Fed's next rate cut. Either way, though, I think that was still a message across the sort of set of Fed leadership that they still have an easing bias here at some stage over the next several meetings and months. And I think that was supportive for fixed income markets. From an economic perspective, we did get another update on initial jobless claims this week, and they did step down for the first time in a few weeks, which was encouraging to see. And I'd say broadly across a range of different labor market indicators, we're still not really seeing any evidence of a notable rise in layoffs from the corporate sector here yet. And that's good news and quite important as a backstop and support for the US consumer, which is the bedrock for the US economy. Our outlook and expectation is that the US can continue growing here over the course of the next 12 months with slower but still positive growth over the remainder of 2025 and into 2026. Finally, around sort of the ongoing policy dynamics, the one big beautiful bill is still kind of working its way through Congress, but one of the very specific provisions within that gotten quite a lot of attention, particularly from non-US investors, has been this item known as Section 899, or what's also been called the revenge or retaliatory tax. And this week on Thursday, Treasury Secretary Scott Bessent actually has now encouraged the leadership in both the House and Senate to remove that retaliatory tax provision from the one big beautiful bill, following on some discussions and negotiations that he's had with his peers globally. And I think that'll be a bit of a sigh of relief for investors globally as they're thinking about the tax treatment of their US holdings. But again, in short, a very strong week for financial markets, particularly in equities, but also for bonds on the back of some healthy fundamentals and a US Federal Reserve that still looks like it's willing to cut interest rates at some point here over the next several meetings. That's all I have for this week. I hope you stay tuned for next time. Thanks a lot. Bye.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.